Good. Thank you, Valerie, for agreeing to. Valerie requires no introduction, so I'll just I won't. Yeah, the floor is yours. Valerie will give us some insights from economic history.
Okay, great. Thanks so much for asking me to speak at this conference. I have to say this conference is just a dream for me to see so much good work on the economics of defense. We're fortunate in that, unlike when COVID hit, we hadn't had a pandemic for 100 years, so we were really ill prepared for that. And even when the global financial crisis hit, we didn't know very much about multipliers. We hadn't studied them for several decades, and so people were just scrambling to try to give answers. The military events happen more frequently, and military buildups were just a great exogenous natural experiment for estimating all the multipliers. So we start with a much stronger base than for those two other sorts of crises. And so I think that we're doing much better this time. We can provide answers more easily. There were so many things I could talk about. I talked to Christoph because he was at the Hoover Institution Geopolitics Conference in February. And I thought I'd just kind of speak more generally and just think about some insights from economic history. And supposing people aren't sure that Mark Twain said this, but he says, history doesn't repeat, but it rhymes. And so there's a lot of lessons that can be taken from history. But also, I have to say, anybody, particularly in macro, we use time series. And anytime you use time series, you're really doing economic history. All right. So any kind of time series paper or case study of older work, such as the R&D work at the micro level, really is economic history. So just as an example of how. Just as an example of how people do look back in time, at the start of a new military buildup, it's natural to compare to previous buildups. And I still have the hard copies of the Business Weeks that I use for my narrative. Here is from March 2nd, 1940. And what do they do there? They look at the current activity during the first 6 months of World War II and compare it to, and this is for the US, during World War I. And you could see for some things, so this is business activity, steel operations, all those things, that there was a big difference. You got an immediate burst in activity during World War II, but during World War I, the US actually went into recession, and they kind of weren't as involved with what was going on over there in Europe initially. So I'm just going to focus on a few topics. As I said, I could speak for hours on this stuff, but I'm going to focus on the supply side, elasticity of output. I'm going to talk about a case study of World War II, where I'm going to think about something beyond the multiplier. We sort of estimate these aggregate multipliers, and people do plenty of micro detail. But this is just going to say, how much can we just feasibly increase output? And then I'll look at the current situation for the US and Europe for the output elasticity, as I call it. Then I'll talk about fiscal space. So you can think of that as production space, fiscal space, and financial repression. And then if I have time, a few brief remarks on multipliers, because there was a paper that was going to be given, but the author couldn't come, although one of the authors is here, and there's a really important point that everybody should know. Okay. So here is World War II. Most people know this. It started in early September 1939. Victory in Europe was in May 1945, and victory in the Pacific was in August 1945. So these two lines indicate the beginning and end of the war for the US. Well, the US wasn't in there, but the beginning of the war there. All right, so this is as a percent of potential GDP, and potential GDP is done with a polynomial time trend that Sarah Zuberi and I use. That omitted the Depression World War II period in thinking about time trends in GDP. These are different intercepts, but the length of the two vertical axes are the same, so you can compare them. So purple is government purchases, And so this shows what happens to government purchases as a percent of GDP during World War II in the US. It went from about 12% up to 60% of potential GDP. All right, so a huge increase in government purchases. Green is the GDP. That went from about 80% of GDP, because we were still, in the Great Depression kind of era. And it went up to about like 125% of potential GDP. All right. So you can kind of look here. You say, what's the multiplier for the mobilization? It's about 1. Okay. The demobilization was very different. And as I'll talk about, I have a recent paper on this called, and I actually presented it here a year ago, why didn't the US unemployment rate rise at the end of World War II? So you can see that everybody thought we were going to go back into the Great Depression, but because government purchases were falling and everybody believed Keynesian economics back then, but in fact, output did not fall nearly as much. The demobilization multipliers were like 0.6 if you just count it from there. All right. So the question is, how could output be this elastic as it was during World War II? So to answer this, I used some new data analysis from my work with Shigeru Fujita. And so let me just give you a little background on there, some of the data, just to also give you an idea of some of the data that's available, even though I only use a small part of it here. So back in 2016, because we were interested in this fiscal cliff where they were going to do sequestration, what would be the effect on GDP? We looked at World War II era. We said, geez, unemployment hardly went up much at all after the end of World War II. So we wanted to understand why the labor market was so dynamic. So we had this kind of, the overall project is called The US in the 1940s, Anatomy of a Dynamic Labor Market. Okay, but we really wanted to do gross flows and where people went. So we created, it took several years, this was before ChatGPT and Claude, so we had a lot of undergrads inputting data, new monthly longitudinal data from 1940 to 1950 on over 10,000 individuals in 6 cities like San Francisco, Chicago, Los Angeles. And they asked people in early 1951 what they were doing every month from 1940 on. We knew who they worked for, where they were working, what their occupation was, whether they received a promotion within the employer. It's better than any modern data set, other than that's just these 6 cities. We also know why they left that job. We know what they were doing when they were out of the labor market. We know what their father's occupation was, all kinds of things like that. So it's called the Palmer study. And thanks to Claudia Golden, who found the records from that study in a closet at University of Pennsylvania and put it in the archives. She used some of it, but they didn't realize that there were the back of the cards that actually had the parts that let us do longitudinal analysis. Okay, she and then Bill Collins had also done. So they were very helpful at giving us the data they had, and then we added much more data. We also discovered amazing rich government surveys, including the precursor to the BLS household survey. So we have very good data. So as I said, our first paper is why didn't the US unemployment rate rise at the end of World War II? We're still revising that. Part of it is because we decided it was too much stuff in one paper. So we also have in progress papers on female labor participation and Oken's law. But then given recent events, as I was telling Shigeru, I said, maybe we should be studying mobilization too, rather than just demobilization. And what I'm going to do just right here is I'm going to use a production function identity that we used in that paper to figure out why the Oken's law became much steeper during the 1940s, because that was part of the answer to why the unemployment didn't rise. But it actually helps us focus on different labor inputs into output. All right, so here's the identity. Well, I should have put identity there. But output is equal to output per hour times total hours, right? That's what it's equal to. Now we can break down total hours into hours per worker times the number of workers, which is the labor force participation rate, times 1 minus the unemployment rate, times the population. We can then look at the growth in each of these, and then just use this as an accounting decomposition to say, where did those extra inputs come from? So here shows the source of the cumulative rise in US real GDP from 1940 first quarter to 1945 second quarter. All right. So as I said, it rose, about 60%, or actually, this isn't a potential, this is just the percent change in, or log change in real GDP. And we're seeing that the biggest part is actually an increase in output per hour. Right? Average hours are also important. I mean, all of these things are big, right? Unemployment rate, labor force participation rate, and a population. Population was basically on trend, so I'm not going to talk about that. But there was some in migration, but not that much. All right. So average growth of output per hour, 6.5% per year. Now, before we get to the most important one, let me also look at demobilization. So this is starting in the second quarter 1945, relative to that up through 1947. Here on demobilization, declines in the labor force participation rate are the most important part. We are getting some declines in output per hour. Unemployment rate's a small amount. Average hours, you're getting some important parts there. Okay, so analysis of these individual components. As I said, I'm not going to look at population because nothing much was happening there. So first of all, if I showed you labor force participation rates over a long period of time, you would just see this big mountain from this. So just to give you some context. So this is for population 14 and over, because that was considered the working age population at that time. Not much happening here. And then it really goes up. And by the way, this includes the armed forces in both the numerator and the denominator. It goes up from around 56% to 64%. And then the war ends and it just goes back down, but not to the previous lower level. We can look at the part contributed by male versus female. Both went up, but female went up much more. And female stayed higher, whereas male, actually, in our paper we discussed, this is basically veterans resting after World War II with their families. But then it's back down to its normal level, but female stayed higher. Armed forces is really important. Conscription started in September 1940. All right, so even though the U.S. is in a chicken run, the old British colonel, who says, "Oh, you Americans, you always show up late for every war," at least they were doing some things to prepare. They putting prescription in conscription in September 1940. And this is a really important part of the rise in labor force for males. And this is actually divided by the whole population. It went up to 12 million. But if you look at the percent of the population 14 over, it was close to 12%. Right? So conscription was a big part of the increase in male labor force participation. We also looked at it by age. Again, finding the precursor to the current population survey makes it that other people I don't think modern people realize existed. Males, now this is just civilian, because they were just looking at civilian there. And then this is divided by the civilian population. Now, given how many males were taken into the armed forces, the civilian male population is shrinking down. So it's relative to, so keep that in mind. You're getting a little bit increase, particularly ages 45 and over, but not much for the middle categories, but definitely the ages 14 to 19. People were basically leaving school. For females, again, 14 to 19 was the biggest in terms of percent of that category. But you also had increases in these three other age groups there. They did all kinds of wonderful studies of female labor force participation. There was the Bureau of, inside the Labor Department, there was the Bureau of Women. I can't remember what it is, but they asked the census to put a question on there, and they asked women in a nationally representative sample, what were you doing the first week of December? That was before Pearl Harbor versus in March 1944. So they were taking this survey around that time. So in December 1941, before Pearl Harbor, there were 12.4 million women in the labor force. 12.1 of them were employed because unemployment rate was higher, as I'll show you. 10.2 million women were in the labor force at both of those states. In March 1944, there was almost 17 million women in the labor force. We can also see who these new entrants, where they came from. So over half came from home production, and a third came from school, and then 10% from other kinds of things. And there's a whole bunch of more data here, but I won't look at it. That was 6.7 million entrants. Even though the war was not over by any means at this time, you still had labor force exits of women, 2.2 million, but 93% of them went back to home production because they were, the value of their time was higher there, and 7% to other. And then in our paper, we study what happened after the war. But so why did the labor force rise so much? Well, if you think about it from a dynamic general equilibrium model, so McGrattan and Ohanian, they studied the increase during World War II, and then Shigeru and I have been studying both the increase and the decrease. It's very surprising. A standard neoclassical model, which you think would not work in a command economy, but I guess since there's a social plan, or maybe they did it without competitive prices. With conscription, you feed through there, you feed through the increase in government spending, and then also GOPO, which I'll tell you about a little bit. But plus you have to have TFP shocks too. The negative wealth effects and intertemporal substitution could explain the entire rise. And this is assuming they have perfect foresight about when the war is going to end. You still get this amazing fit. Now, however, we also think patriotism probably played a role, and we worked through the model where we could ramp up a preference parameter. And then, Casey Mulligan has had papers on patriotism and those sorts of things, but you don't have to rely on abstract notions of patriotism. Many of the women who entered the war had husbands, brothers, and or friends in the armed forces. And Bill Brainerd of Brainerd Tobin's Q and stuff, he told me his father was a manager of a factory during World War II. And every time the Axis had some win, that everybody would work harder at the factory. So effort levels would really increase there. So there was, you knew people in the armed forces who needed those goods. So that's one of the reasons there. Also, I think there may have been a temporary decline in the value of home production since so many men were off at war. The women didn't need to be cooking for them, and they could kind of be roommates. There was also a housing shortage, and so you actually had a temporary decline in home production. There was also substantial slack in the labor market at the beginning of World War II, right? So the official statistics of that time included what are called emergency workers as unemployed. These were people who were hired by the government for make-work government jobs to help with the unemployment. They actually turned out to be pretty good. A lot of infrastructure was built by the WPA. You'll still see it on sidewalks in the US. So the unemployment rate was very high if you include emergency workers, but lower, still over 10%, if you exclude emergency workers from the unemployed. In any case, those emergency workers quickly got jobs with the mobilization. So you can think of them as part of the slack in the labor market. And the unemployment rate ended up down here at 1%. And then this is the big mystery that Shigeru Fujita and I were trying to solve, which is how could the unemployment rate only go up to 4% and stay there with that dramatic decline in government spending? Now, remember, another category was average hours per worker. So just focus on this graph first. Average hours per worker significantly increased and then fell back down. Again, you could say wealth effects. But the more likely, important major factor is that there was government mandated minimum weekly hours at factories that produce war-related goods. all right? Now, why would anybody want to work at those if you had to work more hours? Well, the pay was much better. So if you looked at earnings, hours times pay, people made, very good salaries, even with the wage and price controls. There was a real benefit to working at those factories. And there were all kinds of studies. This was actually a big issue for women because they had trouble keeping up with those long hours because they typically had home responsibilities. And so there was a lot of turnover among women. Now, if we take that labor force participation rate, what was going on with the unemployment rate, what was going on with average weekly hours per worker, all of that adds up to average weekly hours per population. And so that went up a lot from 22 to 30 total, but a lot of that was in the armed forces. So the red is the civilian. That still went up, but you can see this tension between putting in this case young men in a factory or in an army. There really are there's competition between those two goods. And of course, during a mobilization, you need both. And then labor productivity. So we're still working on, this is based on hours that I did for my QJE paper and the GDP from my paper with Sarah Zuberi, and Shigeru and I are looking at it in more detail later. But most estimates, I'll talk about one that doesn't, show that labor productivity increased significantly. So 6.5% growth on average per year during the war. It grew during the heyday, the high productivity years, non-war years for the US, it grew 3% per year from 1948 to 69. So you can just see how high this was relative to even those good years after the war. So why did productivity rise so rapidly? Ex ante, we would expect, gosh, labor productivity should go down. Certainly, at least in the short run, you have diminishing returns to labor, and private industrial capital was falling at this time because the investment was being crowded out. There were many inexperienced workers, right? You're taking a bunch of women from home production, say, be a riveter kind of thing. Bottlenecks were rampant. So you would expect productivity would have gone down. Alex Field, in a JEH article and in a book, argues that labor productivity fell in manufacturing during most of this period. I was really surprised by that because I'd seen papers by like Ethan's, and I said, so in private, I looked into it in much more detail, and so did Bob Gordon. And I think he used the wrong deflators. I can explain that later. So I think productivity did rise, but there's a lot of measurement error. But his narrative still makes very good points about all the factors that should have reduced productivity. So now one thing is industrial capital actually grew faster than civilian hours. So it grew 3.6% per year, civilian hours 2.3% per year. Now I just told you, wait a minute, private investment was really being crowded out. How did it grow? Well, it's this stuff called GOPO, which government-owned, privately operated capital. So the BEA knew about this, and then Bob Gordon also wrote a paper about this in 1969 to explain why productivity didn't fall more. So this is where the government, it's just like some of the government subsidized R&D spending. The government would pay for it. It would be installed in the factory, and then the private sector would operate it. So this is another case where private-public seems to work really well. And I have to say, in the displaced capital paper, the JPE that Matthew Shapiro and I had, I sat down with the manager that the aerospace firm that had done the auction to get rid of all the capital. And I was asking the original price. And there were a few pieces still left over, because I was doing this in the mid-90s. Few pieces still left over. He says, oh, I can't tell you, that belonged to the Army or that belonged to the Air Force. So he didn't, have a number for that. So there was GOPO around still until the mid-90s to some extent. Okay, other possible factors. I realized during the morning talks, I said, oh, I forgot to put government subsidies of R&D, because that also happened during World War II. But there's also the famous learning by doing, although some people say maybe there wasn't so much. Supposedly the Liberty ships, was a key example. But when they got so fast at producing them, sometimes when they'd go out in the water, the rivets would fall out. So, so you have to be careful about quality control. Definitely higher capital utilization. If you think of the work week of capital, that was definitely increasing when you had hours per worker going up. Higher labor effort. I mentioned, the idea of people working harder for patriotism reasons. Ideas were shared across companies due to so there's a wonderful book by Arthur Herman called Freedom's Forge. It has all these details. Basically, the CEOs of all these companies, some of them went to work for the government for $1 a year, and then they would talk to their friends and say, okay, you got to share this knowledge. And an example I like to use is for the Liberator bomber. They were making it in San Diego, but basically with artisan methods, right? It was this beautiful plane, but it was slow. So I think it was Bill Nelson, I can't remember his name, who had been the CEO of GM. He says, I'm going to call my friend Henry Ford. He's going out with his team to San Diego. They're going to break it down into all the little tasks and figure out how to build this much more quickly. They went back to Michigan, built Willow Run, which is 1 mile long. And it was tough on the startup, and this is where you'd think productivity, should go down. But then they managed to produce an astounding number of these kinds of bombers. So there was much more sharing than you would have during normal times. And then there was such a rapid pace of innovation in the second half of the 1930s. They were likely building on that. There were all kinds of innovations that were just ready to be used in all of these different things. This is such an important part, even though people have done a lot of research on this. I think this is something that deserves even more study. Ed Obregante, who's sitting right there, his job market paper shows that you also see this increase in productivity, at least in the short run, in the post-World War II period. So he uses defense prime contracts, shocks to those, to look at the effect on productivity as well as a number of other macro variables. And you can see this is output per hour of workers, and he's getting a positive effect there from productivity. So again, that's why we need more work on trying to figure out why that happens. Okay, so let's go back to the future to 2026. Thinking about how the US mobilized in World War II and say, how elastic can output be now? All right. So the US and Western Europe, we're now building up defense again. I'm going to consider the potential for increases in hours. I'm just going to talk about, let's not forget bottlenecks, and then talk a little bit about productivity. So here's this wonderful new database by Gethin and Sayes, the Global Hours Database. I'm just going to show it to you for prime age workers, 20 to 59, but everything I say is going to be even stronger in terms of these trends if you put, age 20 to 65 or a little bit older. Right? So in all of these countries, so I'm just showing France, Germany, UK, US. I had more before so I could be inclusive, but then you couldn't see any of the lines. So I'm just taking the bigger countries. Employment rate has increased significantly since 1960. And of course, a big part is female labor force participation. Hours per worker, though, has fallen significantly. Say for France, it was 45 in around 1970, according to this database, down to 30. That's the blue line. Germany's gone down. We only have it there from the 1980s, but that's gone down quite a bit. UK has been sort of flat since the 1980s. I don't know before. And the US still remains quite high in terms of hours per worker. Now, if you put together the employment rate and hours per worker, then we can look at hours per adult. And there, again, we're seeing France just really going down over time. Germany, pretty flat. Let's see where, UK kind of going up a little bit, some. And then, the US, which the effect of the female labor force participation, and then there's, some decreases, particularly during the global financial crisis, but still much higher. So if you look at this and you say, well, if French people could work that many hours back then, in a national emergency, they could probably work more hours now. The other thing is, retirement ages, right? People are much healthier at age 63. They could probably do some riveting too, although these days it's something, something new with drones. So what I see is that there is more slack in Western Europe in terms of potential labor than there is in the US. Now, why, it's useful to, if we're trying to make people work harder, it's useful to think about, what is it that leads to these variations across countries and over time. So of course, I didn't put it up here, but over time, you can use Paracrucel and somebody's remembering his co-author, basically income effects, slight income effects that dominate, slight dominance over substitution effects, and that explains why people work less now. But now Prescott argued that Americans work more than Europeans because American labor taxes are lower. Gethin and Sayes' new paper, they're just looking at correlations and simple regressions. But it's really interesting because they find that tax rates are really significant at explaining why Europeans work less now. But then they also have this nice variable on labor market regulations. And it turns out that becomes more important than the tax. It's hard to parse these out, but much more work needs to be done on that. A recent paper by Barinci, Karabarbunas, and C finds that, even American hours per worker are declining, or American hours, I think this must be labor force participation. And they argue that increased healthcare benefits for the non-employed, this expansion of Medicaid through Obamacare, is the source of the decline. It used to be to get health insurance, you had to work for the most part, unless you were, disabled. But then it became much more generous again during COVID. And so then they argued that's actually leading to lower labor force participation. Now, since all of these explanations revolve around government policy, the government could change policies to raise hours if they needed to. Thinking something else about hours. I had to read through historical document like Business Week, leading to all these buildups. And so it certainly caught my attention in the news recently. In April, the US government, and we have people from West Point, so they could comment on this if they want to. The US government raised the maximum age of enlistment from age 35 to 42. Now, when you see that, because I've read it, history rhymes. I'm not saying conscription might be in the future, but if things got dire enough, one could imagine that could happen. All right, so remember, productivity was such an important part of World War II experience, but we really don't know how much was accounted for by different things. So, what matters, of course, is quantity and quality of education, government policies that foster innovation. So government R&D subsidies are estimated to have huge returns. Regulations that do not hamper innovation. And of course, smooth functioning financial markets to help the accumulation of capital. During World War II, the US also helped with credit. So that's another kind of policy that you can imagine that the government could do to foster these sorts of innovations and investments. All right. Current labor productivity comparison. So this is for 2025. So it puts US at 100. The UK's 80% of the US. The Euro areas, they're both around 80%, all right? So there are gaps here. So it seems like if, I still remember your paper, the US does it better. A little bit more diffusion of technology and adoption might, bring up productivity. It hasn't happened during the last 20 years. This graph was from our Bob Gordon. Such a lovely graph. Couldn't even ChatGPT and Claude couldn't do better. This is labor productivity growth over a 20-year period. Portugal did something wonderful. I don't know the background there. This is the US, but you can see Germany was half. Where's France? France was 24% of the growth. You keep having that, and those bars that I showed you before will get wider and wider. But rather than seeing this as a problem, I see this as an opportunity. There's some slack there in the potential productivity. Something else to remember though with productivity is if you have bottlenecks, suddenly your factory's closing down, and of course we know about rare earth and semiconductors. But going back to World War II, there's also still potential low-tech bottlenecks. So in the 1940s, shortages of natural rubber were a significant constraint on the Allied war effort. Make it do, actually save rubber, check your tires now. Turns out for aircraft, you can't just use synthetic rubber for the tires. You've got to mix in natural rubber, and there's a lot of components where you've got to have natural rubber. So there was actually the Department of Homeland Security had a report in 2024 that says it's a key ingredient in over 50,000 products, including aviation, automobiles, and critical medical supplies. And that a sudden decline in rubber inputs would impose significant costs on both the economy and national security. The vast majority of rubber, as it was before, is produced in a few Southeast Asian countries. During World War II, the problem was that Japan controlled those countries. The problem now is that most of it's shipped through the South China Sea. So you can imagine, you might have rubber shortages again. And it takes 7 to 10 years for a newly planted rubber tree to produce latex. So you hear semiconductors and rare earths, but don't forget rubber. One additional thought on supply, and this is, this came to me somewhat when I read the Arthur Herman book, but then also when I saw what happened during COVID. Both World War II and COVID illustrate the incentive effects of guaranteed demand from the government and the tournament nature of the competition. All right, because with World War II, the government said, we need a bazillion planes, but nobody expected the war to go on forever. So whoever could do it first and best was going to get the big demand. And they said, if you build it, we will buy it. And the same with COVID. If you can come up with a vaccination for COVID, then you're going to make a lot of money. All right. So even FDR, who was, a little bit more socialist than the typical American, he realized the importance of the profit motive during World War II. And so, let them do it. So that let them mass produce airplanes in World War II and then operational warp speed for COVID vaccination. So remember that for the incentives. All right, let me talk a little bit about fiscal space and defense financing. So Christoph, you should recognize this graph. I took it from his paper. This wonderful global budget database for 20 countries from 1870 to 2022. And they look at how war booms are financed during these times versus during peacetime booms when they're also raising it. And military spending goes up 84%, 73% of that is from borrowing. 17% is tax revenues, 10% is other revenues. And then and other spending actually goes up. During peacetime booms, you get quite a bit less borrowing, 48%, just because you probably have more revenue on hand to tax if the economy is doing well. If you look at war financing in the US, so Leo Hanian's job market paper was an interesting comparison of World War II and the Korean War. Usually debt and seniorage are the biggest parts of financing. With the Korean War, though, because they were entering with a high debt to GDP ratio, they financed it 100% by raising taxes. So the Korean War started in 1950. And they have their, the The shooting stopped in 1953. What's scary is, given all of the things that are happening, how the US let itself get into this ridiculously high debt to GDP ratio. Every other war they went into, the debt to GDP ratio was really low. World War II was a little different because they had run up so much debt during the Great Depression. With, they were losing revenue, GDP was falling. So of course the denominator was falling, but also, the extra spending. They hit 107%. This is debt in the hands of the public. It came down quite quickly, all right, but I'll talk about that. This is the Carter-Reagan buildup, all right? But then the fall of the Berlin Wall, that came down. So it was about 34% at the start of the new millennium. But then the financial crisis and COVID led to big Keynesian stimulus. All of that stimulus stuff added 23 percentage points to the debt to GDP ratio in the US. And then of course, because of the aging of the population, it's projected to get up to 175%. And that's not taking into account, say, Trump's desire to increase military spending, 50%, and whatever else will hit the economy. That's really important because for the economy is how the US reduced its debt to GDP ratio after World War II. So it fell to 23% by mid-1970s. Wow, that's great. Now, earlier commentaries argued, well, the US just mostly grew its way, Krugman said that, grew its way out of its debt, i.e. R was less than G. Hall and Sargent, however, argued that primary surpluses were an important part of the story. Reinhardt and Srabansia argued that interest rates were low, though, only because of financial repression. And a forthcoming paper by Ackerlin and Ball carefully studied the role of financial repression. So let me just show you two examples. This is from my discussion I have of Auerbach and Yagan at Brookings. It's a published discussion. Just looking at, this is the end of World War II, this is the start of the Korean War. Blue is the outlays. You can see how Korean War looks so big if you don't have World War II in there with relative to the rest. But when you have World War II in there, the Korean War looks like a little blip, but it was still big. And then revenues going there. So you can see that they did start raising revenues, and this is like tax smoothing, to keep the revenues higher, which makes sense. Public debt, though, just fell very quickly. Now, part of it was these primary surpluses, but you can see they're kind of small relative to what was going on here. It turns out this is a big part of the story, is the GDP deflator, right? So I did a decomposition in that discussion where I said, let's look at the log change in the debt to GDP ratio and decompose it into the change in the nominal debt minus the change in the log government growth of output minus inflation. When I do that, it depends on if you do fiscal year or calendar year. This one's simpler. It went down almost 30%, right? They got rid of 30% of that in 3 years. Now, the debt went down some, and that was due to the primary surpluses, the nominal debt. But GDP also went down. Remember, it didn't go down with the multiplier of 1, but it still went down. So those kind of canceled each other. But prices went up almost 30%. Basically, the price controls were lifted. So the US government, for patriotism, asked the US population to invest in all of these government savings bonds to help fund the war effort. They were at these low interest rates. And basically, the inflation tax came and ate up a whole bunch of that. Ackerlin and Ball, they do this in much more detail all the way up to the present. And they look at the effect of primary surpluses and financial repression. And they find that blue is the actual. And between the financial repression and primary balances, which were a smaller part, this is what the debt to GDP ratio would have been if they didn't put that on there. So this is a real worry because let's see, you worry about, because Japan is doing this. There's a paper by Hannah Lustig at the NBR Macro Annual that I co-organized that showed that the way Japan is financing its 250% debt to GDP ratio is basically with financial repression and taking on a lot of risk, by the way. So now there's not much, yeah, there's Japan. So the US is ridiculous, although I guess not as bad as Italy on the debt to GDP ratio, but everybody's has gone up since the beginning of the 21st century. So none of these, Germany's doing really well. Germany's going to have to work more, and they've got the fiscal space to build up. But otherwise, these other countries are in bad shape. And we know that the multipliers on raising distortionary taxes is quite high. So it's a real worry about doing that kind of thing to do it. So this is a big, big issue. I didn't need to have that. So we usually think about aggregate general equilibrium models, but for thinking about military buildups, it's also useful to just pay attention to what kind of slack you might have in the economy if you change government regulations, change incentives, or conscript. US started World War II from a slack labor market. Labor market's not so slack now. European countries are probably significantly below their potential on hours worked and productivity. So I think that there's potential room to grow there. Incentives matter for firms. This is where I was talking about if the government guarantees it's going to buy something, then they're going to innovate and do all kinds of wonderful things. Most countries have no fiscal space. This is a big issue. All right, thanks.
Okay, so we'll open up to some questions.
I have two points that I would wonder, and I wonder whether you considered them. Both are taken from the book Destructive Creation by Mark Wilson, and he describes that this idea of the buildup in the US being linked to US government spending is only partially true because the "we'll buy everything you have to sell" thing was already true, but for the British and the French. Mm-hmm. So he argues that there's a longer tail into the late 1930s of defense buildup. And he also makes a point about breaking up monopolies with the government-owned capital goods, so that the aluminum monopoly was broken up by simply selling it to not the previous monopolist. Are these things?
Oh, that's good. I have not read that book, so when I have paper and pen, I'm going to write that down. No, that sounds like a must read. No, it's definitely the case. So the U.S., once the uncertainty about whether World War II was going to start, once it did, they kind of said, okay, so the stock market started going up in the U.S. in fall because the uncertainty is resolved, and then we're going to have a market for our goods, steel and all of those sorts of things. But then it's just really started looking dark in the 1940s, and it just became clear. And FDR, knew that the U.S. was going to have to get in the war. But he said, "Oh, if this is defense, so we're just trying to defend our borders." But there was a lot of buildup starting then. And so then that example I had about Henry Ford going out to San Diego, that was well before Pearl Harbor. So I would like to read that book. Yeah. Yes, Paolo.
I wanted to ask you something about the UK. You have this beautiful chart you have shown about debt to GDP.
Yeah.
It's not very beautiful.
If you do that for the UK, you get a very similar picture, except that the intercept is much higher. So during the Napoleonic War,
Yes.
During the Napoleonic War, UK public debt to GDP went close to 200%, and then 40% by the end of the century. And then during World War II, actually was 250 before reaching 30% by the end of
I did not realize it went up that high.
So I wonder, do you think this might be a little bit of reason for optimism for fiscal space?
Let's be clear, the UK was the global hegemon and lost that position in large part because of the debt to GDP ratio. Now, as people say, if the US loses, so who would take over? Because, everybody. But no, and it's same with the Netherlands several centuries before. Getting into financial straits is not a good thing. Yeah. And the UK, I mean, their economy grew so slowly after World War II. Of course, there was a lot of bombing and stuff, but they took a long time to recover.
Yeah, so great. So I was absolutely on board with the program of how we can raise productivity by thinking of changing government regulations and other ways to get productivity up. But thinking about the hours dimension and the the patterns that you were showing, I really recall that our former colleague Steve Nicol had this paper called when looking at the difference of hours in the US versus continental European countries. So are Europeans lazy or Americans crazy? And by that he meant that it's a bit of a surprise in the US that despite this huge increase of GDP, hours work seems so high. I mean, you think you take hours as a leisure, as a leisure, it's better. So you should expect to see more full. And so it is a little bit of a puzzle in why hours haven't fallen so much in the US in the sense of you could say so you were kind of positioning it as the European regulation and tax, but it could be there's something else happening to keep American hours high. And preferences are one thing, but it could also be, for example, inequality increases. So, the benefit of being in the labour market is high wages, but there's also a huge cost because if inequality is low, you lose health insurance, you lose all other things. So, in some sense, the increase of inequality, which is stronger in the US and the UK, could be one of the factors propping up the hours work.
Except the people working the hardest are the most educated. So there's been a reversal. So if you look at because I did all this work on work and leisure over the 20th century. At the beginning, in 1900, the less educated people had higher hours of work per week. And then over time, Dora Costa also has this. And then at the time that crossed, and Eric Hurst and them have several papers where this is part of what they're finding. It's the higher educated workers who are working harder. The low educated workers have lower labor force participation rates. They don't work, as many weeks per year, kind of thing.
It could be labor supply because the video games or it could be labor demand for the reasons we were seeing before because of all the negative shocks that low wage workers face. So
yeah, but the more educated workers are working harder than I don't know ever, but they're keeping their hours up. So yeah, so your basic studies like that are just really useful for thinking about defense.
I mean, I guess in terms of thinking about the opportunity, say we have to increase hours worked in Europe. To the extent it's some preference thing going on, then you need a change. You need the war to galvanize a change of culture, a change of preferences. So we can't have retirement at 63 France.
And then you want to let people kind of re-enter the labor market. So my next door neighbor in San Diego. So I actually live in San Diego still on the weekends and work at Stanford during the weekday. But the neighbor works for a Boeing defense subsidiary, and he retired last year. But then he told me after the fact that he says, I got recalled back. I said, yes, I'll do it, because they were setting up all of the logistics for the Venezuela operation. So, and there was a very experienced, basically my age person who said, I'm going to retire. We've got enough, but then was very excited to get back into that. So, and it made it easy, I think, the government, just the way regulations are. I don't know how it works with Social Security. I think you just get a little bit more tax, but not so much. So, yeah, having incentives for people to re-enter the labor market, that's something that people should think about. Because in the US, it used to, I know because Leora Friedberg worked on this, the marginal tax rate on somebody who was getting Social Security who then decided to work some more was just astronomically high. And it was during the 90s, they lowered that. So I want to make sure that happens. Anyways, I'm standing between people and lunch.
Any last, okay, one last one.
Thank you. Thanks so much for the presentation. I was just curious if you've done much work looking at other countries' experiences and whether or not you find much variation in the multipliers that you showed for the US. Is there any reason? I mean, obviously there may be different constraints, but I'm just wondering if you've looked at other countries.
The reason I haven't done other countries is the fact that there was so much capital destruction in the other countries in World War II, that just complicates things a lot. Yeah, I mean, that's the main reason. So I say somehow the US manages to always fight wars on somebody else's territory, except for the Civil War. Nobody would let us fight our Civil War on their territory. So that's why it's such a clean experiment. And that's why, those of us who are interested in multipliers and just using defense as a natural experiment so we could get exogeneity, would always gravitate to the US. Plus the US, if you look at the British, after World War II, we've got the Falkland Islands, which is this little blip. You just don't get enough variation in the data.
Thank you so much for this very illuminating talk. Served where we had the coffee earlier, and we will resume at 2 o'clock.
Yes.
And you will maybe resume.